Good morning, everyone. Thank you for joining us. This is our first symposium with the Citrin Cooperman High Net Worth Group. We got a great program today. We have Michael Dooley, who is our Chief Compliance Officer, is going to give us an update on the state of the economy. And then Mary Delman, who is head of our T&E group, is going to talk about some estate planning issues in 2025 and beyond. Please ask a lot of questions. This is for educational purposes. So please ask a lot of questions. We're here to help. And without further ado, Mike, please take over.
Hey, Pat. Yeah, thank you for the introduction. As Pat mentioned, I am the Chief Compliance Officer and a partner of Citrin Cooperman. I run the Wealth Management Department along with two of my other partners. And what we're going to do is give you an update on the economy, including what's happened over the last week, which has really been kind of incredible. We'll get to that and its effect on the overall market, talk a little bit about the political environment. So without further ado, we go to the first slide. The first slide here is showing the CPI index for the month of June. It fell by 0.1% month over month and rose 3% year over year. It's important to note that this is the first month over month decline since May of 2020. Jeff, if you want to go to the next slide, please. So this slide right here is going to show that year over year that I just mentioned. That 0.1% helped moderate the CPI to its slowest annual pace since June of 2023. I think in our view, it's a welcome report from the Fed, and it should further increase confidence that inflation is on its way back down to that 2% target. June's inflation report, along with last week's job report, we'll touch on that in a moment, does support the view that we're getting closer to a rate cut perhaps as soon as September, which is 2 meetings away. There's a meeting in about 2 weeks, and then the next one in September. Next slide, please. So this chart right here is going to show basically the overall inflation CPI by component. As we all know, or most of us know, the Fed has a dual mandate: keep prices stable while promoting maximum employment. A weakening labor market might therefore force the Fed to begin easing its monetary policy in order to help get down to that 2% target. Core goods inflation here, we're showing is represented by the line in purple. That change in the cost of goods, excluding food and energy, typically affected by short-term inflation expectations and import prices. And then if we look at core services, which is represented by the brown, that's obviously the change in price of services affected by long-term inflation expectations and the labor market. The 2 lines that you'll see in blue and a darker blue, or it's a green, I should say, and a darker blue, headline inflation and core inflation. Headline inflation, just for reference, the raw inflation figure, it's reported by the BLS. That includes everything in the economy, including food and commodities, which are often quite volatile. Core inflation is a number more so that the Fed likes to follow, because it strips out food and energy. Next slide, please. This slide is what basically the CPI is showing and measuring by its components and constituents. So if we look at the June 2022 number, which was the highest inflation in recent times, compared to the blue, which is the inflation numbers that came out last week, it really eased across the board. We finally saw a welcome move with lower shelter prices, and also saw favorable declines in gasoline and airfare prices. The next slide, please. So again, I'm going to focus on shelter because that's the one I think it's been affecting most people, and it's also one of the ones that's been quite persistent since COVID started. So just for reference, the shelter component of CPI, it includes 2 major two items. Number one is rent of a primary residence. So think of anybody who rents an apartment. That's about 7 to 8% of CPI on any given period. And then the second calculation is the owner's equivalent rent, which is basically the amount of rent a homeowner would pay if they rented their home out on the open market. This is a 23 to 24% value of the CPI, so just under 1/3, which is why it's the biggest component, one of the biggest components, and also it has quite a lagging effect. The reason for that is how the government calculates it. It's basically used by a staggered panel of individuals who rent and own homes, split into 6 groups, who are surveyed twice a year. So, for instance, there might be somebody, one group, one sample set that is asked or reporting in January, and then that same group might not report till June. So again, it's pretty staggered, and changes in the rental market dynamics can take even a couple of years to be quantified. So what we're actually seeing right here is the downward slope in that shelter component, but that does look about 9 to 12 months in the past. One of the reasons for the softening, what we saw was rent surging during the pandemic because demand outpaced supply. But due to incredibly low interest rates, multifamily construction also dramatically increased. And as these projects start wrapping up and coming online, we're starting to see some shifts back into the renter's favor for actually having some options in order to rent some units at lower prices. Next slide, please. So here we have 2 charts that basically describe what I just talked about with regards to the CPI report and the shelter decreasing and why it decreased. We had a gradual slowdown in multifamily because of this pipeline of if you look at the slide on the left-hand side, it's showing the level of completion for new supply that's coming online. So during the pandemic housing boom, low interest rates, easy access to capital inspired a lot of investors to go into multifamily development, especially in the Sunbelt area. With these projects wrapping up or being close to completed, we're seeing this huge surge in market supply with forecasts of about 550,000 units hitting the market, 650,000 units hitting the market this year. If you look on the right-hand side, that's just a sample set, pardon me, of where the majority of housing is coming online, and it's basically been a function of where we're seeing the population. A lot of the population, a sizable portion of the population, I should say, is moving south. No surprise, primarily due to higher quality of life, lower taxes, lower housing costs, pleasant weather. It seems to be, based on the statistics we read, the epicenter of multifamily development. If for those of you who don't know, if you basically draw a line across the United States, starting at the bottom half of California, go across to North Carolina, anything below that is the Sunbelt. It's important to note the Sunbelt now holds about 50% of the population, and it's expected to rise to about 55% by 2040. Additionally, the region accounted for 80% of U.S. population growth last year, 12 out of 15 million people, which is pretty, I'm sorry, over the last decade, which is pretty incredible. Next slide, Jeff. Thank you. So moving on to the job market, off the inflation numbers, we had a mixed bag when the numbers came out. It basically showed the economy added 190,000 new jobs during the month. And while that was below the consensus of 206,000, it suggested the economy is still growing. However, beneath the surface, the job market kind of might not look as healthy as the headlines suggest. For starters, the previous 2 months totals were revised 111,000 jobs lower taking some of the froth out of last month's outsized gains. And if we're looking into the change in household employment, I'm sorry, change in household employment, the gain over last month was 116,000, bringing the 3-month change to minus 267,000. And while the change in labor force over the same period was an increase of 114,000. So the unemployment rate registered 4% as well, the highest in touching 3.4% since January 2023. And it's not saying it's the labor market's presenting a picture that is poised to show the economy slipping into a recession. There is a trend developing which could represent a risk to economic growth that we're witnessing. And next slide, please. So here's where we look at according to CME, the odds of at least one Fed rate cut by September 18th. The combination of the weakening jobs market and improving inflation was enough for Fed Chairman Powell to really strike a dovish tone at the most recent testimony before Congress last week. While describing the dual mandate of stable jobs and low inflation, he said inflation has shown modest further progress, but labor forces have cooled considerably. We'd interpret this as meaning a rate cut has once again been moved to the front burner of the FOMC's agenda. And I think that was only exacerbated a couple days later, as of the morning of the CPI release last week. The Fed forecast is for a 92% chance of a September cut. So pretty, I'll say the odds are in the favor of our first rate cut in quite some time since pre-COVID in the Fed funds rate. Next slide, please. This slide is one that I tend to follow very closely. Is the Fed dot plot. It's a chart of that's updated quarterly. It records the 19 Fed officials' projections for the central bank Fed funds rate. Each dot reflects what each of the central bankers think would be an appropriate midpoint for the Fed funds rate at the end of each calendar year. Some of the numbers that are taken into consideration are GDP, unemployment, PCE inflation, core inflation, things like that. However, what we're seeing on this dot plot here is it's showing that, or trending that, we're going to get a 25 basis point rate cut before the end of the year, and then another 100 basis points next year, another 100 basis points the following year, getting us down in 2026 back towards that sort of that 2% rate that the Fed is trying to manage us towards. Here's sort of a slide that we put up because it's one that it doesn't get talked about all that often. The United States national debt is trending towards around $35 trillion as of right now. The charts here were at the end of 2023. If we look on one of the top left, that's showing what the debt service is, which is actually it's late last year, early this year, it hit $1 trillion. So if you think about all the Treasury bonds outstanding that the U.S. has to pay interest on, it is now $1 trillion in payments on an annual basis, which if you look at the bottom left, supersedes basically most very well-known government plans, Medicare, spending on children, veterans, so on and so forth. If we look to the top right, as a function of the federal debt as a percentage, the debt as a function of spending, we're approaching, I'll say, modern day times, reaching between 14 and 15%. Again, quite high. Not that it hasn't been done before, but it is a very high amount. It's something that we should all be cognizant of. And on the bottom right, interest cost as a percentage of GDP is about 4%. Again, in modern times, it's projected to be an all-time high, assuming things trend as projected over by the Pete Peterson Institute. Next slide, please. So now let's talk about what effect rising rates, rate cuts may have on the overall market. So this right here, we'll start with the fixed income side. This right here is basically showing a chart of the Barclays or Bloomberg Barclays U.S. Aggregate Index, which is the broad-based index for which all bonds are measured against in the United States. This bond index, if we look, we basically saw it move into positive territory last week. All the gains for the year, for the most part, happened in the month of July, when the rhetoric from the Fed, coupled with CPI numbers and the labor numbers, really made it apparent that interest rate cut cycle might begin. Right here, this moved it into positive territory. Obviously, as I mentioned, the duration on this, for reference, is about 60 years on this index. And what that means is the index, for every 1% move in interest rates, it should be represented by a 6% move in the bond market. So if the Fed cuts, if we're going linear and we're showing the Fed's dot plot showing a 225 basis point of rate cuts, we should have in excess of a 12% return in the bond market over the next 2 years. Next slide, please. So what this slide shows is, if we look since the 1980s, since 1980, what the bond market will do, utilizing the same index, or what the bond market has done, I should say, during periods of interest rate cut cycles. So it's kind of incredible. If you look at the 1980s, I wasn't around then, but interest rates starting at 20%, pretty incredible. Showing that interest rate deltas, meaning the beginning rate and the ending rate, if we look at the difference between those, of anywhere from 11% to about 2%, what that translates to is a positive bond market performance. If there's anything to be shown for what will happen to a bond portfolio, again, measured by the U.S. aggregate, there are a lot of bond strategies out there, but measured by the U.S. aggregate total return, again, about a 6 duration on that on average, what we should get is a positive return on the bond market. And we really have seen quite the turn in the bond market over the last week alone. If we were to look at a longer dated, a longer duration index, returns would only be exacerbated. On the contrary, if we looked at a short-term index, the majority of those would likely be red. Next slide, please. So moving over to the equity side, this is a chart that was put together just before the turn in the market, just before those inflation numbers came out, and during the Fed testimony, we're showing a difference here. If we look at the top 500 stocks as measured by the S&P 500 in the United States, it's incredible how linear this chart is, showing the top 50 stocks increasing by 13.1%. Again, encompassed in that are going to be the NVIDIAs, the Googles, the Metas, Teslas, all the high-flying stocks this year. And quite the reverse, if you look at the lowest 50 stocks in the year, we're showing in a minus 12% to 25% delta, which is pretty incredible. So it's just showing, again, disparity between the largest companies and the smallest companies. And then on July 11th, there was a remarkable turnaround in so many asset classes. Next. So this right here is looking just at a chart of a ratio between U.S. large caps versus U.S. small caps. Very, very long trend here of large cap outperformance, really starting in 2010. There's a brief period of mean reversion in 2021. If we look during that period right after COVID, but that was really erased and then due to the continued growth of the mega cap tech names. Until last week, it was at a 2-decade low. In other words, until last week, we were seeing the lowest relative strength of small and mid cap stocks as compared to U.S. large cap since 2000, which was the bust of the dot-com bubble. you all remember that one. Next slide is going to be the same chart, but we're going to see here the relationships between large cap growth and large cap value. It could quite incredible, and really shows the reason why you should be invested across all, I'll say all asset classes. Obviously, you can be tilted towards some with higher conviction, but if you had a portfolio that was solely invested in U.S. large cap value, you significantly underperformed large cap growth over the last 20 years, over the last 10 years, over the last 5 years. This is again, this is interesting. If we look on the left-hand side of here, basically for the year, it really, in one day, losers became winners, winners became losers. Regional banks, small caps, REITs, international value, all of these really turned strongly. And all the winners is the complete opposite. Really sold off, starting at the bottom, the Teslas, the Nvidias, anything growth related sold off dramatically. On the right-hand side, again, another comparison between the top 50 stocks and the Russell 2000. The spread was a 4.5% difference between the two, which is the second largest on record, just behind October 2008, which was a 7% move. Here's the slide, the current volatility right now, compared to historical averages. I wouldn't say we're at an all-time low, but trending towards the lower side of the spectrum. Pardon me, over the last 30 plus years, it's the second lowest in 18 years. And what I basically wanted to show here was, just because we have lower volatility and the markets have done quite well, it doesn't necessarily mean we should hesitate, pause, wait for a correction in order to put some dry powder to work if you've been waiting. Next. This is a reason I always enjoy this slide. It's the reason since 1930s of reasons not to invest. Again, going on that volatility or parlaying off that volatility chart, there's always going to be a reason not to invest, no matter what you're looking at and you want to put money to work. But assuming you're working with an advisor and you have a plan and a timeline for when you need the money, if you have an investment horizon. If you go to the next slide, there is a continuous reasoning on this slide why you should again put that money to work and invest and not hesitate and wait for a correction. If we look at 2024 alone, on the left-hand side of the chart, this is the S&P 500 number of all-time highs. Again, this is at all as last week, all of these charts. This schedule is showing we made 37 new all-time highs. It's probably 39, maybe 40 now since the chart was made. But if you were to think the markets hit an all-time high once, twice, 3 times, 4 times, 5 times, you're missing out on the S&P. The broad-based index, that's up probably 18% roughly on the year. The chart on the right-hand side is going to show us how that through the first 131 days, which was as of last week, the S&P 500 did, and then how it did for the remainder of the year. And aside from the years whereby there was something dramatic happened, where are the numbers you see in red, the majority of the time with a strong start like we've had, these markets only continue to get stronger. Again, there are some instances where in 1929 we obviously had a massive stock market crash, 87 massive stock market crash, 43 World War, depressions. But barring any unforeseen, really large economic event, the trend would show us that the calendar year 2024 should end in positive territory. So moving on to the political scene and political scenarios right now that we have facing us in a few months. These are just some some things on what we would anticipate would happen if indeed we had a GOP sweep, if we had status quo with a divided Congress, and if Trump wins with the divided Congress. Really with the GOP sweep, 2017 tax cuts renewed, extended. Mary's going to touch on some of that in just a moment. GOP Senate can unilaterally confirm president nominations. We learned that previously. With a split divided Congress, with a Biden win, 2017 tax cuts revised. Again, we talk about that with Mary in just a few minutes. And GOP obviously has veto power on president nominations. And then if we have a Trump win with a Democratic House, again, GOP can still unilaterally confirm president's nominations, and we're going to see some more stuff with the tax cuts renewed or extended, is what it's trending toward. So I'm going to go to the last slide. Again, this is sort of what we are, what we're reading, what we're seeing. Tax policy would expand 2017 tax cuts. If we look at the Biden side, one of the things that I would say is the most important to look at on this is the proposed or discussions about a wealth tax. That's going to be something that there's not much yet on how it's all going to be calculated and all done, but it is something that I'd say should be concerning to anybody that has any sort of real assets, because they would need to plan accordingly in the event that something like this happens. It's just something to be very cognizant of. So without further ado, I'll pass this back to Pat. Mary's going to take over. Mary's going to talk a little bit about the estate planning side and touch on what a potential change in presidency or extension of the current president can have on your current tax situation.
Thank you, Michael. Very informative. We just thought it would be very important for people to get a understanding of what's going on in the economy and what changes should be made and really what people should be looking at. As Michael pointed out, that you should be investing your money and not putting all your money all in one basket. So it's great to diversify, and that's where you're going to continue to create your wealth and grow your wealth. So we're going to dovetail into, 2025 is quickly coming upon us. And as Michael alluded to, there could be a lot of changes in the estate tax world as we get into 2025. Mary's going to give us a high-level review of what could happen and what you should be thinking about now. So if these changes are made, that you're positioned best to manage these additional tax issues. Mary, why don't you educate us a little?
Thank you, Pat, and welcome everyone. I'm Mary Delman. I co-lead the trust and estate practice here at Citrin Cooperman. I'm an attorney, but I've spent most of my legal career in the accounting world space. So what I'm going to talk about today is a very important change that's coming up in the estate and gift tax laws at the end of 2025. Michael touched on it briefly. Whether or not this change will follow through will depend in part on how our election goes at the end of this year. So right now, we're operating under the assumption that it's going to sunset, but we'll see what happens. You might think that the end of 2025, it's a year and a half away. There's plenty of time, but we've been saying that for years, and now we're at a point where it's getting closer and closer. And it's important to plan now to avoid a last-minute rush. Your advisors will all be extremely busy by this time next year, and that includes your tax advisors, your financial advisors, and your trust and estate attorneys. So we recommend that you start thinking about what we've discussed here on this webinar and really, putting some thought into, what your next steps are for your estate and gift tax planning. So just to give you a quick background, the Tax Cuts and Jobs Act of 2017 increased the lifetime exemption amount for estate gift and generation skipping transfer taxes. It increased it from 5 million to 10 million, and it's indexed for inflation. So for 2024, the lifetime exemption amount is 13.61 million per individual. And for married couples combined, it's 27.22 million. And that's a large amount. So just briefly, what is the lifetime exemption? This is the amount that you can transfer gift and estate tax free to your beneficiaries. There's no tax if you stay within this limit, and this is at the federal level. So just to be clear, everything I'm discussing right now is federal. This provision is set to sunset on December 31st, 2025. So as of January 1, 2026, this lifetime exemption amount is going to go back to that 5 million per individual number, index for inflation. So I'm going to say it's probably going to be around 7 million when it reverts back. It might be a little under 7 million. It might be a little over, but I'm going to work with the $7 million number now as we go through this webinar. There's also an $18,000 annual exclusion for gift tax, and it's $36,000 for married couples. I mentioned the married couple number because very often we have our clients making gifts and they're splitting gifts with their spouse and treating the gifts made as one half by each spouse. So this is indexed for inflation in $1,000 increments. This is not set to sunset. So every year you have this per donee exclusion that you can utilize, and this gets utilized before you tap into your lifetime exemption amount. And one thing I want to mention about estate planning, there's the tax side of the planning, right? You want to be, tax efficient. You want to reduce your estate and gift taxes as much as possible, but you also need to consider other factors that go into your estate plan, and that could include your estate size, type of assets that you have, family structure and dynamics, and also the state tax laws, which we'll touch on later on in the webinar. Next slide, please. So utilizing the lifetime exemption before it sunsets. Yes, this is what we recommend. Use this exemption if you can. It is a use it or lose it situation. So if you don't use it by the end of 2025, it goes away and you're back down to that, let's say $7 million number. So consider making substantial gifts before the end of 2025. This will reduce your taxable estate and save significant estate taxes. The highest estate tax rate is 40%. That's also the highest gift tax rate and the highest GST rate. So that's a significant tax if you have a taxable estate. So let's try to reduce that estate as much as possible. The IRS has confirmed that there's going to be no clawback of the exemption. So what this means is that if gifts made before the sunset, so before the end of 2025, you're using the higher exemption amount, you're not going to be penalized after the sunset. So if you die and the exemption is 7 million, but when you made the gifts, it was the 13 million that we have today, you're not going to be penalized for that reduction. So there's really no downside to using it, other than one thing I do want to mention is that when you make gifts and you transfer assets out of your estate, you lose control of those assets. There are ways to maintain some control, but you have to be very careful that you don't bring it back into your estate. And some people just don't want to give up control. So that could be a consideration when determining what to do and how to best use this lifetime exemption. Another downside is that when you transfer assets out by gift, you lose the step up in basis. Your donees receive your assets at your basis. So if they were then to sell those assets, they're going to have a capital gain tax. If the assets stay in your estate, you get a step up in basis to fair market value, which significantly reduces capital gains tax. Now, we're looking at a capital gains tax rate of 20% versus 40% estate tax. So, in my opinion, it's better to avoid that 40% estate tax. And in order to benefit from this higher exemption, you really need to transfer amount above the future exemption amount. So that's that $7 million amount, but keep it under the current exemption amount, which is the $13.6 million amount. So you want to try and get assets out of your estate higher than that 7 million, but keep it under the 13 million so you're not subjecting yourself to gift taxes. So just for example, if someone gifts 12 million now, and the estate tax exemption goes back to 7 million in 2026, you've moved an additional $5 million out of your estate and gift tax free. So that's a great way to, you know, move some assets out, and all that future appreciation on those assets as well as moved out. Next slide, please. The generation skipping transfer tax. This is a separate tax on transfers made to someone 2 or more generations below the donor. So this is a grandparent-grandchild relationship, basically. It is a separate tax, so it's tracked separately. It's a separate exemption, although the exemption is the same as your lifetime estate and gift tax exemption. So it is a $13.6 million exemption, but it's tracked separately. And it will be sunsetting at the end of 25 as well. So we recommend that when you're planning your gifts, not only plan to use that estate and gift tax lifetime exemption, but also plan to use the GST exemption. Also, considering, and yeah, okay, so, all right, next slide, please, sorry. Okay, review and update estate planning documents. So, as an attorney, I always tell my clients this, even though I cannot provide legal advice, I do recommend that every once in a while, they take a look at their documents, their wills, their trusts, just to make sure they're up to date and they reflect their current wishes. Yes, a tax change is one reason to review these documents, but there are other reasons. You might have a marriage, you might have children, there might be a death in the family, your financial situation may change. Maybe for business succession planning, you need to update these documents. So many reasons to every once in a while take a look. You should be discussing these documents not only with your attorney, but with your tax advisors, just to make sure that you're carrying out your current wishes, but that your plan is tax efficient. And it's utilizing these exemptions and all of these other opportunities to reduce your estate taxes. Once again, don't wait. Please start looking at this now. You can put if you decide you want to create a trust and take advantage of the increased lifetime exemption, you can put those trust documents in place. You can have your attorneys draft them, and then you don't have to execute them until next year. Maybe we'll have a better idea of what's going to happen. Maybe we'll know by this time next year. I'm not so sure about that, but maybe. And then you can sign them and you're good to go. And make sure that you're also speaking with your financial advisors and determining what assets are best to transfer into these trusts. So I've run into situations where clients want to transfer assets and you can only transfer them at certain times of the year, or you need maybe a 2-week, head start to get them transferred. It can't be done in a 24-hour period. So it's best to plan for all of this. So then when you're ready to execute and actually make the transfer, you've got all your ducks in a row and you're good to go. Next slide, please. Okay. Creating trusts. So if you don't want to make outright gifts to use your lifetime exemption, trusts are a great option. Maybe you have minor children and you're not going to obviously hand them the cash, or you have children that are younger, or they're just not financially savvy and you're afraid they're just going to go spend it all and not have anything in the future. So we recommend trusts. They provide some control over how the trust assets are managed and distributed, because you can capture this in your trust agreement. So for example, you might say that when my child reaches age 35, they get 1/2 the trust assets, and then at age 40, they get all of the trust assets. So that gives you a little bit of control on how these assets are distributed to your beneficiaries. Dynasty trusts, I'm just going to go over a few trust options. There are many, many more, but it really depends on your situation, and happy to discuss offline, in more detail with anyone other options with trusts. But for now, we'll discuss the dynasty trust because this is a way to utilize both your lifetime exemption for estate and gift tax and your generations giving transfer tax exemption, and to provide for multiple generations. So you can provide for both your children and your grandchildren, and this can provide for these beneficiaries for years to come. So maybe it might even get to great grandchildren. A spousal lifetime access trust, or a SLAT. Now these are very popular these days because they're very good for people who are not comfortable making larger gifts, like $13 million in gifts, but they really want to use that higher exemption, but they're afraid that if I give this money away, what happens if, a few years down the road, I need that money. So this is a great option. You transfer assets into an irrevocable trust, so they're out of your estate and they're not going to be subject to estate taxes. And you make your spouse a discretionary beneficiary, and that gives you, the grantor, indirect access to those assets. So should you need them down the road, through your spouse, you can get to those assets. One thing to keep in mind, if the spouse passes away, you no longer have access to those assets. But these are very popular, and if drafted correctly, they can be very effective in utilizing your lifetime exemption amount. Next slide, please. GRATs, grantor retained annuity trusts. So these are trusts that are great for assets that are going to appreciate significantly in a short period of time. Generally, we see them for a 2 to 5 year period, these trusts run. And they remove these highly appreciating assets from your estate. They provide the grantor an annuity, so there's a steady stream of income, and all of that future appreciation is moved out of your estate. There are ways to, this is a great tool if you've used your exemption and you don't have a lot of exemption remaining, but you still want to move assets out of your estate, because you can set the annuity payments equal to the fair market value of the assets, which creates little to no taxable gift. And another benefit is a GRAT is a grantor trust. So with a grantor trust, the grantor pays the income tax earned. So you're not depleting the trust assets, you're moving more assets out of your estate because you're paying the tax, and it's not considered an additional gift. One thing to be aware of, GRATs and grantor trusts have been an IRS target over the years, and we really can't predict what's going to happen if the IRS will actually follow through or anything will get approved, but just wanted to mention that as an aside. Irrevocable life insurance trusts. So these are great because this allows a trust to hold life insurance on your life. You can either transfer an existing policy into the trust, or the trust can purchase the policy. It's out of your estate, so you're not going to be taxed on the proceeds of the policy. And the trust can use those proceeds to provide liquidity to the estate, should you need it to pay estate taxes or other expenses that come due when someone passes away. Next slide, please. Okay, portability and DSUE. So portability allows a surviving spouse to use the unused portion of the deceased spouse's lifetime exemption. So basically, first spouse passes away and they've used 10 million of that $13.6 million lifetime exemption. The surviving spouse or the executor of the estate can elect to take that remaining $3.6 million and pass it on to the surviving spouse. And that gets added to their existing $13.6 million exemption. So it's a great tool. And it's beneficial if the first spouse dies before the sunset at the end of 2025, because you're working with that larger exemption. I am in no way suggesting that we start planning for spouse's demise, but just saying if it should happen, it's something that you can take advantage of. And even if the exemption sunsets at the end of 2025, the DSUE, which is the deceased spousal unused exemption, that will not decrease. So whatever amount is being transferred to the surviving spouse stays intact. To elect portability, the executor has to file an estate tax return for the deceased spouse. and make that election to transfer the remaining exemption to the surviving spouse. The estate tax return, it's a little more of, it doesn't have to be as detailed as if you were filing a estate tax return that was for a taxable estate, but it still does need to be filed, and asset values need to be reported on that return. And just one other thing on the portability, this is only available at the federal level. So please be mindful of your state taxes, because your exemptions may end up being different at the federal and the state tax level. Okay. Other planning opportunities, just a few things to mention. Charitable contributions, so charitable giving. So charitable contributions can reduce your taxable estate. This isn't necessarily a way to use your lifetime exemption, but I wanted to mention it because if you're charitably inclined and you like to make charitable gifts, then, you know, consider doing that. You can either do outright gifts, or you can establish a charitable trust, and both will benefit from the charitable deduction for both income tax and gift tax. So this is a way, you know, to move more assets out of your estate. And valuation discounts. So with closely held businesses or family limited partnerships, for example, you could get valuation discounts for lack of marketability and minority interests. And we sometimes combine discounts will be 35, 40%. So that's a discount on the fair market value of the asset. So if you're making a gift and you can leverage these discounts, you can transfer those assets out of your estate at a reduced gift tax cost. It can also reduce the value of your taxable estate when you value those assets on your state tax return. Okay, state transfer taxes. Just want to mention this because people often forget that we have this great $13.6 million federal lifetime exemption, but some of our states have their own separate gift, estate tax, and inheritance taxes, and we need to keep that in mind when planning. Quite often we see wills and trusts that reference the federal exemption, but they don't reference the state exemption, and we've seen, you know, unfortunately, some instances where this has created a taxable estate and estate taxes due because the documents and the plan is only focused on the federal exemption. So Connecticut is the only state with a gift tax, and we have several states that have an estate or inheritance tax. And just to give an example, I'm in New York, so I do a lot of planning for New York residents, and New York has an exemption, and we call it the cliff, because what happens with New York has a $6.9 million estate tax. New York doesn't have a gift tax, so let's start with that. So you're making gifts, you live in New York, and you're not going to be subject to New York gift tax, but they get you at the estate tax level because their exemption is $6.9 million. But once you it phases out once you hit that 6.9 million. And then if you get 5% over that number, which is 7.2 million and change, you what we call fall off the cliff, and completely you lose that exemption. So you're getting taxed on estate tax for dollar for New York. So a lot of our planning for New York with our clients is trying to get under that $6.9 million exemption for New York, so that we're not going to be subject to New York estate tax. Or people move out of New York to a state that has either no estate tax or better exemption. Next slide. Okay, so just to conclude, so what I really would like you to take away from this webinar in the estate planning realm is that what you should be focusing on. So focus on utilizing that current higher exemption amount before it sunsets. I know everyone has a different, scenario and situation, and I find it really difficult to plan for those clients that have wealth in between that $6 million and $13.6 million exemption amount, because you really need to get over that $7 million to take a benefit out of the higher exemption amount. But some clients with maybe $9 million or $10 million of net worth, that's giving away a significant amount of their estate, and they don't want to part with that because they'll need that money. So sometimes we have to be a little creative or come up with other ways. Maybe we're using one spouse's exemption and holding on to the other spouse's exemption. There are many different ways to plan for it. You know, just keep in mind, as I said before, you really need to get over that $7 million hurdle to really benefit from this increased exemption. And also reviewing and updating your estate planning documents. It's really very important. Consulting with not only your tax professional, but your trust and estate attorney and your financial advisor. You really need to have all of these advisors on board with your estate plan. You want to make sure that it's optimized for tax purposes, but you also want to make sure that this plan carries out your wishes. And it's really important that you have everyone, you know, giving their opinion and looking at this plan. You need your financial advisor to help you choose what assets are best to transfer now, maybe what you should be holding on to. Also, if you're creating trust, like charitable trust, you know, you might want to put certain assets into the trust to get some income tax benefits. So once again, it's very important to have everyone on board with your plan. And just want to add that it's difficult to predict what's going to happen with this exemption. We've been here before in 2012. The exemptions were scheduled to decrease at the end of 2012. There was panic and there was chaos, and there were a lot of poorly drafted trust agreements that we've seen because people rushed to get everything in place. They didn't account for, let's say, like state taxes. They didn't adequately carry out a client's wishes. And then after all that rush and chaos and everything else, there was no decrease. And then after the 2020 election, we went through this again. That following year, we must have had 3 or 5 proposals out there, all different scenarios on what was going to happen with the exemption. So there was more fear, panic, chaos. What are we going to do? And in the end, there was no decrease. Exemption remained the same. And things have been quiet for the last few years. So I wish I could tell you what's going to happen. I can't, but hopefully after the election, we'll have a little more chatter on where we think things will be going. So thank you, everyone. I hope this was helpful.
Thank you, Mary. Very helpful. Does anyone have any questions for Mike or Mary? You know, bottom line, as Mary was alluding to, don't procrastinate. You know, reach out to your advisors sooner than later to try to get a plan in place and, you know, implement that plan. But you need to reach out to your advisors, you know, sooner than later. Do we have to use deceased spouse DSUE before personal exemption?
So I assume when you say personal exemption, you mean your lifetime exemption. Yes. So the DSUE gets tracked on your gift tax return, and you use that amount before you tap into your own lifetime exemption. If anyone thinks of anything after the webinar, feel free to email Michael, Pat, or myself with questions.
All right. Thank you, everyone.
Well, thank you, everybody.
Yes, thank you all.
With us. You know, like I said, if you have any suggestions, please, we're open. We want to make this constructive for everyone. Thank you again, everyone.
Perfect. Thanks, everybody.
Bye, everyone. Thank you.
Bye-bye.